Hello, good people. You're most welcome to the Actuaries Promise, your promise show that is revolutionizing the insurance world, that is improving the confidence levels people have had with the insurance sector. And the ultimate goal is for you to embrace the culture of insurance, the culture of risk management, the culture of keeping something for the rainy day. So where today we're going to change a little bit. I'm going to take you through the history of insurance because as an actuary, compared to the accountants or other financial players or professionals, most of them look in the past, and of course we all deal with numbers, figures of economics, income and things like that. But while an accountant looks at the past performance, what are your records, your accounting records, and everything, the actuary wants to look at how to forecast for the future, how to safeguard any challenges if they happen at that time. How do you plan for them now, such that when they happen, they don't take you aback? So much as we are people of numbers, we are interested in so much figures, mathematics, and all that calculations. Today, I want to take a step back and look at the history of insurance. Just the way, if we look at our Ugandan scene, we look at, say, the banking industry. It has a history as well, but it's not about up to about 20 years ago. I think that was about early 2000 that the banking institutions really were embraced and the banking population increased significantly. Because before 2000, people having bank accounts there was a small percentage of people community having bank accounts, but with the millennial bug coming in, many people embraced taking on bank accounts, and bank accounts became something as free as many of them were free. I remember I opened up mine towards that time around 99. I was still in primary school, and I've had it ever since then. And possibly this is where the insurance is going to go. We want to reach out to a point in time when everyone will have at least an insurance policy. But these insurance policies can be, of course, informed by some of this information you're learning here, but also informed by policy of giving or looking at what the consumer gets at the end of the day. What is in it for the client or for the beneficiary of insurance? For instance, I was having a discussion with one of the consumer um, protection people who look out for the consumer rights protection, who give me a simple scenario. And this is something we need to think about as insurers, whereby people who are moving in public means, whenever they get accidents, how do we get to those people very fast and give them compensation so that they can get back to their feet? But many times, the buses are insured, but then the people who are there, the pedestrians, the passengers, sometimes don't get compensated because they don't know where to turn to. Yet, if we had a system of ensuring that all these tickets, all the clients who are booking tickets for the buses have some electronic way of getting their data, we would easily just refer to that information and look out for the people who have passed on or who have gotten injuries, or we look for their next of kin so that people get to understand or people feel the importance of insurance. Just like I felt that importance or I felt that benefit when I got this bump that you're seeing right now, this scar that you see here, that happened to me just last year, but I bounced back and all thanks to insurance, medical insurance in specifically, but there's also group personal accident that we have talked about in the past few weeks. And there's a lot we can do if we start these conversations. And this is what this promise show is going to bring to you. We're going to be bringing on various stakeholders and all the regulators, the players themselves, the loss assessors. We want to look at the whole spectrum. In fact, I want to let you know that even banks have joined the space of insurance because we're now giving them licenses to transact with what we call bank assurance licenses. So they choose the insurance companies they want to work with, and life is going to become just better if we are armed with this information and we embrace this culture in a better way. So, with that introduction, I'd like us to go for a short break and then come back and drill deeper into the history, brief history of insurance worldwide, not just in Uganda, but worldwide. A fact, actually, about 4,600 billion US dollars was spent in insurance just in the year 2012. But industrialization, welfare, innovation, economic development, and modernization per se would not have been the same without private insurance. Since 18th century, building insurance on solidarity, business acumen, and the logic of calculation has proved an almost unbeatable business idea. Trade and migration and immigration became the second most important enablers for creating a global insurance safety network. Some of the large catastrophes proved too big to deal with for some companies. For instance, the San Francisco earthquake of 1906 to the Hurricane Bestie of 1965, or the attack of the World Trade Center, Twin Towers, that was 9/11, that was 2001. And the industry had to cope with the unexpected enormous losses. Overall, the industry has proved remarkably resilient over this time, this long time. So this history is almost 150 years of solid, of remaining in the industry, and we want to go another extra 150 years. So a long history of prudent reserving and risk awareness has taught insurers to act a little bit cautiously. So while today the link between risk, new ventures, and growth seems self-evident, risk was often seen through the lenses of fate and met with acceptance rather than def- defiance in antiquity. This, what I mean here, is protecting against misfortunes in the past was perceived or seen as interfering with divine providence, with the gods. For millennia, prayers, pilgrimages, donations outperformed the insurance premiums. Indeed, as late as the 19th century, insuring against death was likely to arouse controversy among clerics. There were acceptable ways of alleviating losses, like sharing risks within the social or business communities, risk mitigation based on solidarity common among guilds. These were like the fishermen, they would come together and they insure their small boats whenever they are going out to fish and to get oil. Because this oil used to be gotten from whales. So if you look at all that, that is where the real marine insurance began. Then most seafaring nations distributed cargo on two different ships to hedge against the storms and pirates, while fraternal organizations provided ex post forms of solidarity, spreading the risks in such a way that it had its limits. Also, early forms of mutual insurance, whereby premiums were paid ex ante, meaning you you pay when the problem happens, But though they lacked a sophistication of the modern enterprise or modern insurance that we're seeing today. So insurance has evolved over time. Telling you 150 years is not a short time. And we've been in the industry, and it has been proved that it has seen nations develop and economies thrive, and possibly we are just at the tip of the iceberg as Africans. We are just beginning this journey that people began many years back. So let's embrace this time, and without boring you so much, let's go it into the conjuncture, from conjuncture to calculation. Now, in the 1654, the French nobleman Chevalier de Mere was vexed by uncertainties in his gambling pastime. He wanted to know the chances of rolling a 6 in a certain sequence. Mathematicians Blaise Pascal and Pierre de Fermat used an old pyramid of numbers and eventually were able to prove the mathematical probability could be determined. This triggered a revolution in the development of probability theory, and mathematicians all over Europe cooperated and applied these findings to calculate life expectancy. Much as this attempt of predicting the future was in direct opposition to church doctrine, it was the church whose mortality tables provided the same. Oh, I beg your pardon. It is the church whose mortality tables provided some of the input used in those early probability calculations. So, isn't that interesting that some of these churches or clerics who are opposed to probability actually had come up with these probability tables, mortality tables. And these mortality tables were used to discover the role and plans of the divine creator, to prove the clear regularities and divine order behind the apparent randomness of mortality. So the priests then, or the clerics then, of course, back in the day, 16th century, it is the church as that was ruling the world. But they were also keen to find out, they did their statistical analysis to find out what was killing people at that time. So they used to take details, records of what was killing people then. And it is from those mortality tables that arose the life expectancy and life insurance. Actually, it bought life insurance. Life insurance was slow to adapt to the new science. Various forms of annuities prevailed, resembling gambling more than assurance, e.g., the Totin schemes, named after their creator, Lorenzo Totin, enjoyed great success in Italy and France. They were fraudulent or were badly undersubscribed and eventually were turned into simple life annuities. It was only in the 18th century that life insurance was put on a healthier footing. James Dodinson, a 45-year-old English mathematician, having refused insurance because of his advanced age, he got so annoyed that he searched for a mathematical solution in order to form a more equitable base upon which to calculate premiums as a percentage of the life expectancy. His principle was adopted by the English Equitable Life Assurance Society in 1766. On this model or basis, the Welshman Richard Price later developed a cost and accounting model. In 1774, he calculated the profitability in life insurance for the equitable life based on the current and expectable mortality, so that the current state of the operations could be assessed more precisely. From then on, life insurance no longer relied on speculation, but on calculation. So you're seeing this brief, yes, and it's a little bit of a bore, but it shows we need to appreciate better where we have come from. The birth of modern insurance, or the age of reason, Enlightenment of the 17th and 18th century, provided grounds for accepting actuarial science as a rational means of to conduct better business. Insurance, especially life, resonated with the search for laws and statistical recording of natural events and calculations of future developments. Behind this innovation was the conviction that the world and its possible future states could be predicted and computed. So, insurance was the ideal laboratory for enlightened business ideas. The process of collecting different types of institutional and personal information and using underwriting to transform it into quantifiable costs was important. It created a vital counterbalance to the new and potential destabilizing forces that were transforming the division of labor, urbanization, and the economics of trade. It also helped money become a means of communicating within the economy and contributed more and more problems were being expressed in terms of cost and time. Well, there's a lot. There's a lot we can talk about the history. There's about a booklet that I got about 20 pages, but there's a lot. But let me just briefly summarize as we conclude today's telecast. There is the global expansion. So, as a series of wars in Europe and Anglo American conflict came to an end in 1815, insurance was finally able to spread on a broader scale beyond Europe and USA, which had imported the British invasion from almost from the start. Based on growing trade and the wake of immigration, the British system was gradually adopted in most white settled colonies in the Americas, Australia, New Zealand, and South Africa. It remained a privilege of the European settlers and traders to insure themselves and their businesses, while the local communities rarely embraced the concept and preferring to remain with their traditional ways of guarding against misfortune in form of family and village solidarity alongside trusting God and the unknown things. And it's still happening in our community here in Africa. We still rely on the Nigina groups. We still rely on Harambe. The Swahilis, the Kenyans have it a lot. We still rely on uh, the Bibina, yeah, or your friend, your brother, your family members to bail you out whenever you get a challenge. Yet that is not sustainable. So we are seeing this happened in 1850s, 1815. That is when um, insurance now turned from the modern insurance we are seeing today, transformed from the English people, the Europeans mostly, because even those who colonized Africa would get insured. But of course, the Africans were not understanding the business then. But now we have become of age. We need to embrace this concept. And possibly we also need to inform our policymakers to embrace this. Okay, reinsurance. Both the size and the number of risks to be insured began outstripping the capacities of the insurance industry towards the second half of the 19th century. Traditional insurers resorted to sharing risks among each other or reinsuring with other reinsurers. By implication, if not by design, this practice required competitors to grant each other access to their books. It also increased the likelihood of accumulating risks regionally and in certain lines of business. One way of avoiding these problems was to seek reinsurance across national borders. This meant capital flight Yet capital at the time was a sought after commodity needed to keep up with the industrial and economic development. So, early specialized reinsurers such as Colonial Insurance and Swiss Re were thus founded to stem the outflow of capital flight and strengthen national economies. Moreover, large catastrophes such as the Hamburg fires and the Glacks of Switzerland had increased the need of spreading risks beyond the local insurers. So, reinsurers were an eminent way of providing additional risk capital and comparatively inexpensive to set up and run, not needing the large sales force of direct insurers. They started to spread risks more broadly than their clients through these international and were active in many lines of business, which allowed offsetting of losses in one line with gains in another. This is what we call fledging. You, of course, have very many classes of business, but there are some that are more risky than others. And that's why there is a term we call selection or anti selection. So, for instance, my cameraman here cannot just come to an insurance company and he says he wants just his camera to be insured. You cannot just come to the insurer and say that I want my laptop to be insured. No, that is anti-selection. You must increase the exposure by adding some other assets that you have alongside. Could be your phone, could be your office equipment, so that the insurer doesn't feel that you're only bringing the things that are most risky to him to insure. He needs to see that he has also other things that are not as risky. So that is the concept also that the reinsurers used back then. And that's how they have determined the premiums over that time. When you go back to history, there are so many factors that have affected the way we do insurance now, like the San Francisco incident, where fire following earthquakes had been excluded for many insurance contracts. But the scene of devastation made it impossible to determine whether the fires had been caused directly by the earthquakes or not. A heated dispute arose in the insurance industry far beyond the US, as the companies from almost the entire insurance world had a share in the losses. Should insurers pay even if it was clear there was no legal obligation to do so? San Francisco was rebuilt 3 years later from this uh, fiasco, because there was a big discussion in that time. And it took 3 years to rebuild a whole city of San Francisco, because we had to involve all the insurers at that time, not just in the United States, but even in Europe. Of course, Africa we didn't have, also Asia we didn't have. Yeah? All these were subsidiaries, the ones that were in Asia at that time. All insurers contributed premium and compensation, reserves from their money to compensate a whole city of San Francisco. So money matters. World War One was not insured, but its effects were deeply felt by the industry. There was a change in the world, and the monetary politics also changed. Free trade came to a halt, and the currencies began showing volatile moves. International insurers found themselves having to find ways to hedge against currency losses. Life insurers, especially in inflation ridden countries like Germany, were forced to recalculate their premiums. Insurance again became a national issue, and almost all major exporters of insurance among Germany and the USA retreated from the global stage as trading with enemy states was ended. Only reinsurers were able to maintain their international presence and thereby help to spread risk geographically. Yet, they too saw an entire entire markets disappear with revolutions in Russia and Mexico. Russia gradually shut off its market entirely while the Mexican Revolution was hot, but the peso so much that doing business became unviable for insurers. So there was hyperinflation in German. It forced German companies out of the remaining foreign markets, and entire classes of insurers collapsed as the rates had to be adjusted weekly and even daily. UK abandoned the gold standard, and 25 countries followed suit, allowing the protectionism and capital control takeovers started to emerge. Trade agreements were now only made bilateral, and import quotas were fixed. Many insurers, which had invested in foreign markets, went bankrupt, while some countries tightened their supervisory laws and further reduced the market share of foreign insurers. But let me go now to the good news, because there was a booming economy shortly after the World War II. Home markets suffered their share of problems. Hardly any sector illustrates this better than the money insurance or the motor insurance. From the 1960s on, the Asians, the Asian markets began having an impact on the global economy. In South Korea, a series of revolutionary reforms of 1962 affected the insurance industry and laid grounds for what later would be dubbed a tiger economy, averaging 8% growth per annum. Premium volume surged from 66,000 US dollars in 1963 to about 1.5 billion US dollars by 1980. The tiger economy was something to reckon with. The government contributed enormously to the growth by promoting in the year 1977 as the year of insurance. When the market was opened in 1980, foreign companies helped shift sector growth into overdrive, and today South Korea insurance market is among the top 10 worldwide. The global boom also ushered in new forms of unknown complex risks of far greater proportions, like the atomic reactor, the supertanker, the aircraft, and large building rights. All these forced reinsurance companies to rethink about the limits of insurability. Proportionately, sharing in the losses of a client was not an ideal solution to large insurance. A new class of reinsurers recruited from universities and began engineering risks together with their clients, and gradually, reinsurers developed a new identity as risks experts and insurers of last resort. There are more money matters that came into place, like mergers. Um, we saw the acquisitions, the catastrophes of the 1960s. Then the investors, well, the Wall Street also crashed a number of times. And there was a lot of bad things which came around the Y2K millennium bug. When it came to early 2000 or coming to 1999, everyone was agitated by the millennium bug. Everything. Some people had predicted the end of the world, and indeed, there was a poor start of the 21st century. In many ways, many millennium, the new millennium began amid widespread optimism, with benefits of globalization and technological progress. However, optimism was soon overshadowed by fear and uncertainty, epitomized with the industry's major challenges, including terrorism, financial crises, natural disasters, pandemics, longevity, even living for too long, like in Japan, is also a problem. And then changes in the regulatory environment. The attack or the terrorist attack of 11 September 2001, which we deem as the 9/11, claimed the lives of almost 3,000 people, many of whom worked for insurance and other financial services firms. This strategy of 9/11 ushered in a period of political volatility and global security concerns. The insurance industry shouldered much of the economic burden. Insurers paid an estimate of 23.8 billion US dollars, making 9/11 the most costly insured man-made disaster ever at the time, and the second most expensive insured loss after the Hurricane Andrew. Assessing the insured loss was a highly complex undertaking. Large claims were filed for a number of seemingly unrelated risks, including aviation, property, liability lines, business interruption, and life insurance. Insurers realized they could no longer offer terrorism insurance on the same terms as in the past. Once offered as a blanket cover with property insurance and with little consideration for price and uh, accumulation of exposure terrorism, I beg your pardon, with, with little consideration of price and accumulation of exposure, terrorism cover was immediately withdrawn by all but a handful at large to think differently about risks. The attack brought the global economy to a grinding halt due to the uncertainty, and the effect of stocks worldwide was also affected. The dot com bug preceding the 9/11 and the ensuing political uncertainty of wars affected the investment of insurers and reinsurers, causing many to write down the value of their assets and reduce the exposure to equities. There's a lot that was affected during this time. These losses accelerated the trend of low rates and increasing the liability claims that eroded the profits of many US insurers, and almost overnight, the cost of insurance went up. This hardening market for insurance helped restore profitability, but within 4 years, the market faced a second major catastrophe, which was the Hurricane Katrina. First made landfall as Category 1 in Florida on 25th August 2005. 4 days later, it came ashore again as a Category 4 storm. It caused massive damage to New Orleans before moving inland to wreak havoc across southern US. At the time, Hurricane Katrina was the most expensive catastrophe ever recorded with a total loss of 135 billion. This totally overshadowed what was paid out in 9/11, which was just 23.8 billion. It has since been surpassed by the 2011 Tohoku earthquake and tsunami, which caused 210 billion. Although Hurricane Katrina remains the most expensive insured loss at a value of 75 billion US dollars. That is what was paid out. I know by now you must be exhausted, but let's just go in for a short break and then I round up with this brief history. Then we shall get into more interesting things. Thank you. Keep tuned. Let's come back as we conclude this interesting, though a little bit boring topic of history of insurance and just the global economics before we get to Africa, as I will conclude. So, besides prompting a greater focus of analyzing accumulated exposures, the hurricane was a boom to the growing catastrophe bond market, which enjoyed its best year ever in 2007, issuing about 8.5 billion US dollars in protection. The Chile earthquake of 2011 and the European windstorm Cynthia, Cynthia floods in Australia both in 2011 and 2012, and the Canterbury earthquake in New Zealand, Hurricane Sandy, and the largest insured loss in Japan's history, the Tohoku earthquake, and the tsunami were exceptionally severe tests of strength for the insurance and the reinsurance industry. For the global banking sector, the financial crisis of 2008 was a catastrophe for the real economy, and it brought on the most severe and dramatic decline since the Great Depression. This global banking sector and the financial crisis of 2008 as a consequence of those mortgages that happened in the US economy that were really undervalued and yet were quite high, caused a serious depression that some of us in Africa are still facing today. In fact, it caused one of the biggest insurers here in Uganda and Africa, actually the world, to close many of its subsidiaries, most of its companies in these other regions, like Uganda. AIG closed because as a result of this catastrophe or this financial crisis. With a business model and regulation that is different from banks, insurers weathered the financial storm unleashed by the subprime mortgage crisis and the failure of Lehman Brothers in 2008. Overall, the insurance industry has proved remarkably resilient to the problems of other sectors. The crisis demonstrated how insurers are not exposed to the same liquidity issues as banks. Confidence in the insurance business model was again reinforced. Insurers caught in the financial storm of 2008 fell into two camps. One, there is a financial guarantee insurers, and the second category were those that participated in the bank like activities such as credit, default swaps, and derivatives. Majority of the insurers around the world experienced few issues besides the impact of volatile investment markets, and even at that level, previous financial crises have taught them the importance of rebalancing their portfolio, which to a degree mitigated underwriting losses. This alerted policymakers and regulators around the world to the need to find consistent regulatory standards and the increased cooperation between supervisors and their insurance players or the people in operations. It also reinforced the need for more robust risk management and governance reflected on the insurance regulatory reform. And in the US, the Dodd-Frank Wall Street reform and the Consumer Protection Act brought sweeping reforms of the banking and established Federal Insurance Office to collect data on insurers and recommend changes to state regulation of insurance. European legislation lagged the US on the same to the same degree. In the mid 1990s, the US had already adopted an overall risk-based model for capital requirements, which is the RBC, which we're actually beginning to see here with our regulator. We shall be bringing them to explain further how we're doing it. Imagine this was done in mid 1990s, and in Uganda, we're just beginning to work on it in the year 2021 and the year 2020. But it's beginning to happen now. So while Europe at the same time was still using the Solvency I system, largely based on solvency regime in the EEC had put in place for insurers in 1973 and mainly relied on defining capital requirements for insured risks, more sophisticated risk measures, models, and methods have been available over 30 years. And so the Solvency II directive was drafted with a much wider scope, but also with a broader impact on insurers. This is because the cost of tighter capital requirements for insurance ultimately fade through to products, but in the same cases cannot be passed on onto the consumers. Although many countries around the world adopted the US type risk based capital regulation system and the Solvency II directive, the Solvency II directive has a number of huge impact on insurers worldwide, even before its impending implementation. It provides useful guidelines to setting up comprehensive enterprise risks management for insurers, but it may also prove very costly to implement. Ultimately, there's a lot we can talk about till the hands crawl, but all this is just to give you confidence that we have come from very far, and we, as Africans, shouldn't lag behind. We need to move with the times. We need to know that we can't grow really without expanding, protecting our base. And insurance is precisely about covering your base, such that should anything happen when you are trying to expand to higher flights or other aspects of the business growth, should anything happen and you bounce back, you have somewhere that can push you back to where you have been. Those are some of the basic principles of insurance. We talk about proximate cause, we shall talk about subrogation. There's a lot to learn, but all those are other principles that we shall look into as we move with this show. For more information on the topics we have shared for today's topic and other topics that we have been sharing in the past, please tune in into our YouTube channel. Subscribe as much as possible. Give your comments on the topics that you want to learn and bring more stakeholders to elaborate further on those topics. Go on our Twitter handle, which is going to be put on the screen below. There's a WhatsApp number. You can always chat your comments there. And let's revolutionize. Help me change this industry for the betterment of Africa. Let's leave Africa in a better place than we left it. If this show was not called The Promise, we would have called it Restoration. We would have called it Peace of Mind. We would have called it so many other things, because this topic is all about those things, making you think of other things, other core businesses that you're doing. Think of other aspirations, like go and live and read, research. You have time for all that instead of just concentrating on your core business. You have to protect it, and you become just a subsistence owner of a business. You are not going to think bigger and aspire for better things or bigger things, because you can't expand. You can't think beyond your business. You can't think out of the box. But if you have hedged these risks to a bigger player, both the insurance company, which insurance company has reinsurers, which reinsurers as an international body have several lines to report to, so such that they make sure that you, the consumer, are put back to your rightful position, which you were at before you got insured or when you were insuring. That's the principle of indemnity. So there's a lot we can discuss. Please share your feedback. We'd like to hear from you. Let's tune next time. Please remember to hope for the best while preparing for the worst. I remain Emmanuel Sanyi Safali, bringing you this promise show that is going to get bigger and bigger. Thank you, and let's get back next time. Be blessed.